Money is not static. Through history, from seashells to coins to paper bills to plastic bank cards, how we exchange value evolves. In the 21st century, the frontier is digital. The term digital dollar often refers to a central bank digital currency, CBDC, a digital equivalent of a country's national currency, issued or backed by its central bank. A CBDC would be like a digital liability of the central bank, usable by ordinary citizens, businesses, with balances recorded or maintained electronically rather than in physical cash. Proponents of CBDCs argue that digital money can make payments faster, more efficient, and more inclusive, especially for people without access to traditional banking. In theory, a digital dollar could enable instant payments, more transparent monetary flows, and easier cross-border transfers. However, as with every major shift in money's form and control, there are trade-offs. A CBDC may give state authorities unprecedented visibility and potentially control over financial flows, raising concerns about surveillance, privacy, and centralized power. So when one hears Digital Dollar Act or Digital Dollar Policy, it could refer to measures legalizing or regulating a CBDC or to actions that block it altogether. Under the administration of Donald J. Trump, recent moves did the latter. Rather than support a government-issued digital dollar, the U.S. shifted toward a regulatory path that supports private digital currencies and stablecoins while banning CBDCs. The result is a kind of financial control plan, but not one of state-controlled digital money. Instead, one built on legislated private digital assets. On January 23, 2025, President Trump signed the executive order titled Executive Order 14178, Strengthening American Leadership in Digital Financial Technology. This order marked a sharp pivot in U.S. digital asset policy. It did several things at once. First, it put a bright line under CBDCs. The order explicitly prohibits the establishment, issuance, circulation, and use of any CBDC, that is, no digital dollar issued by the central bank within U.S. jurisdiction. This means the government is rejecting the idea of a sovereign digital dollar, at least for now.
Second, while banning CBDCs, the order simultaneously promotes private innovation. Digital assets, blockchain technology, and related technologies, including dollar-backed stablecoins, are to be supported, regulated, and encouraged. To coordinate this shift, the order established a new regulatory body, Presidential Working Group on Digital Asset Markets, Working Group, under the umbrella of the National Economic Council. This group was tasked to produce, within months, a comprehensive regulatory framework for digital assets, including stablecoins, clarify bank and fintech activities, and define how regulation would be structured across federal agencies. This two-pronged approach, banning CBDCs while promoting private stablecoins, reflects a deliberate strategic choice. The U.S. would reject state-issued digital currency, citing privacy and sovereignty concerns, but still try to lead in digital financial technology through market-based, regulated private alternatives. As one analysis put it, reject sovereign digital currency while embracing regulated private alternatives. In short, the idea of a digital dollar remains, but only in the form of private stablecoins, not a centrally controlled CBDC. And that shift forms the core of what many critics call Trump's financial control plan. The U.S. Congress followed the executive order move with concrete legislation. In mid-2025, lawmakers passed the Genius Act, the first comprehensive stablecoin regulation in U.S. history, and the president signed it into law on July 18, 2025. What does the Genius Act do? Its key features. It requires stablecoins, digital assets pegged to the U.S. dollar, to be backed one-to-one by actual U.S. dollars or other low-risk liquid assets, like short-term treasury securities. Issuers of stablecoins must publicly disclose their reserve holdings monthly, ensuring transparency of backing. The law prohibits stablecoin issuers from misleading consumers. They cannot claim their coins are federally insured, backed by the government, or legal tender. It establishes dual federal and state regulatory supervision. Stablecoin issuers must comply with anti-money laundering laws, sanctions enforcement, and other financial regulation frameworks. In case an issuer becomes insolvent, holders of stablecoins get prioritized claims over other creditors, a consumer protection safeguard. In signing the Genius Act, the Trump administration declared a goal to make America the undisputed leader in digital assets, drive investment and innovation, and modernize the payment system. Stablecoins backed by U.S. Treasury assets would, the administration argued, reinforce the global dominance of the U.S. dollar, ensuring its role as the world's reserve currency into the digital age. At the same time, the law implicitly accepted that money, or at least dollar-denominated money, is becoming digital. But rather than have a government-issued digital dollar, the USA will have regulated, private digital dollars. That is the pivot, from sovereign issuance to regulated private issuance with oversight. Some observers describe this as a privatized dollarization, or a transforming of sovereign monetary control into a hybrid public-private system. At surface, the Trump policy seems rooted in innovation, modernizing finance, embracing crypto, making transactions faster, protecting consumers. But beneath lies a complex interplay of financial control, political influence, and global power dynamics.
1. Cementing dollar dominance digitally. By promoting dollar-backed stablecoins, the U.S. is effectively exporting the dollar's reach into the digital realm. These stablecoins could be used globally, in trade, remittances, cross-border payments, potentially reinforcing the dollar's dominance even as other currencies or digital alternatives rise. Moreover, by tying stablecoins backing to U.S. Treasury assets, the policy could drive more demand for Treasury securities, strengthening the United States' fiscal position and global financial leverage. In effect, the digital dollar becomes not just a payment tool, but a strategic instrument of U.S. monetary power. 2. Private sector control with heavy regulation. Under this regime, money is no longer only in the hands of the central bank. Private companies, banks, fintech firms, payment firms can issue stablecoins under strict regulatory oversight. That means private actors, if licensed and compliant, now play a central role in money issuance and circulation. This blurs the traditional boundary between government money and private money, yet under a framework that claims to ensure stability, transparency, and consumer protection. 3. Oversight, surveillance, and control under the guise of transparency. Ironically, while the administration banned CBDCs, citing privacy and surveillance fears, this credit-based digital dollar regime may still enable significant control and oversight. Issuers must disclose their reserves monthly. AML and sanctions compliance is mandatory. The government obtains tools to freeze or burn stablecoins when legally required. This could make financial flows more transparent, but also potentially more traceable, especially for international transfers or cross-border transactions. For governments and regulators, that's a feature. For individuals concerned about privacy or censorship, it could be a concern. 4. Risks: financial, systemic, and geopolitical. Some critics argue that shifting to private stablecoins may actually create new vulnerabilities. Because stablecoins are still run by private firms, trust depends heavily on reserve management, audits, and compliance. If issuers fail, or if reserves are mismanaged, the ripple effects could threaten financial stability. Indeed, some analysts warn that the physical infrastructure and oversight needed to support large-scale stablecoin systems, servers, power, networks, aren't trivial. By refusing a sovereign CBDC, the U.S. risks losing influence in global standards for digital currencies. Over 130 countries are reportedly exploring CBDCs, many considering privacy-preserving or programmable money systems. If the U.S. cedes that space, other powers might define the architecture of the global digital money infrastructure. During crises, financial downturns, pandemics, sudden shocks, a CBDC could allow governments to deliver direct monetary support, stimulus, welfare, aid, instantly. By banning CBDCs and relying exclusively on private stablecoins, the U.S. might lose that tool permanently. Hence, while the policy promises innovation and control, it also involves trade-offs between privacy and oversight, between state power and private market influence, between financial inclusion and systemic risk. The phrase financial control plan might seem strong, even conspiratorial. But under the hood, the Trump-era digital asset policy does amount to a plan for control, albeit not traditional control by central bank or government, but a hybrid control, regulatory, structural, and mediated through private sector intermediaries. Consider the following. The state no longer holds a monopoly on issuing digital money, but it regulates and permits certain private actors to do so, under its rules. The dollar remains dominant globally, now via digital channels, preserving U.S. influence over global finance. Private sector firms may gain considerable power. Issuers of stablecoins become gatekeepers of digital dollar liquidity, circulation, and payment infrastructure. The government retains kill switches, ability to freeze, seize, or burn stablecoins under legal orders, enforce compliance, oversee reserves, and audit financial flows. For citizens, routine payments, remittances, business transactions could shift to stablecoins, meaning financial activity could be more traceable, digital, and subject to oversight. In that sense, this is not a free-for-all deregulation, but a managed deregulation. It is deregulation on one level, private stablecoins allowed, but regulation on another, strict reserve, compliance, transparency, and oversight requirements. The net result? A controlled and regulated digital money infrastructure, tightly interwoven between private firms and public oversight. What does that mean for everyday people? Potential benefits: faster payments, cheaper cross-border transfers, easier access to digital finance, especially for those underserved by traditional banking. It could democratize financial services in ways conventional banking never did. But there are also concerns. Will the private firms issuing stablecoins treat holders fairly? Will transparency become surveillance? Will discretionary freezes or seizures be used arbitrarily, especially in politically sensitive times? Will economic crises or regulatory failures cascade into systemic instability? And on the global stage, by declining to issue a sovereign digital dollar, the U.S. may unintentionally cede ground. Other countries developing CBDCs, perhaps more flexible, more programmable, maybe more insidious, could define the global standards of digital money. The U.S.'s role may shrink, even if its dollar remains dominant. Finally, the private digital dollar system may deepen inequality. Those with access to fintech firms and digital infrastructure benefit most, while those without internet, banking access, or digital literacy may be left behind. In sum, the financial control plan embedded in Trump's digital dollar policy isn't about issuing a central dollar CBDC. It's about building a privatized but regulated dollar digital infrastructure under careful state supervision. This script explores how that policy unfolded, what the legal and financial consequences are, and why some call it a plan for control, even without a state-issued digital dollar. Money is more than pieces of paper or ledger entries. It is trust. It is sovereignty. It is power. And when money becomes digital, those aspects become more subtle, more embedded in code, regulation, algorithms, reserve backing rules, and governance frameworks. With the Genius Act and related policies, the U.S. under Trump has charted a course, rejecting a centralized digital dollar, yet embracing a digital dollar future built on regulated private stablecoins. That may seem like pragmatism, but it is also a form of control, not by overt fiat, but through structural, legal, financial architecture. For citizens around the world, from New York to Dhaka, this shift could reshape how we think about money, identity, privacy, sovereignty, and power. The dollar remains dominant, but in digital form, and that changes everything.